I can show with clear evidence that bigger isn't always better. It's more units, but that doesn't mean anything. It means you could still lose money. The other thing you need to realize is what hassle factor do you want to sign up for? If your life is already busy, you have 20 minutes a day and that's all you have to devote to this, you don't want to own apartments. You want to own single family homes.
Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach. And this is a show to help you build a profitable and passive rental property business so you can get out of the financial grind and do more of what matters. Whether you're a first-time listener or a long-time listener, thank you for being back for another episode. The title of this episode is How to Go Big, One Rental at a Time. This is an interview with Michael Zuber. If you pay attention to real estate investing online or watch it on YouTube, you've probably heard of Michael Zuber. He's written a book called One Rental at a Time that's done really well. He also has a daily show, which kind of blows my mind as a podcaster who tries very hard to put out one show per week. But his daily show talks about real estate investing, talks about the economy, talks about trends that affect us as small real estate investors. So I'll have a link to his show and what he has going online in the show notes below. But my last conversation with Michael almost a year ago is one of my most popular episodes of the year. And it's for good reason. Michael comes with a lot of experience. He's been investing for 22 years, but I also really appreciate the groundedness of his philosophy. And in today's episode, we get into a topic near and dear to my heart that I think has some crossover with his own approach, which is, should you go big as a real estate investor? Or maybe should you take a one rental at a time approach, staying small and mighty? And what are the benefits of doing that versus going big and growing even faster?
I do believe the turtle approach is the right for most people. I frankly believe if you get to 4 and only 4, your life fundamentally changes forever. 1 a year, 1 every 2 years, 4 single family homes, paid off by the time you retire. Your financial future is light years away from anyone else.
I also, of course, talked to Michael about his 2023 market predictions and what we might be able to expect as real estate investors.
I think we're in a period of the next 2 weeks where rates will go higher. I actually believe that mortgage rates will touch 7% again. And then what we will see kind of middle of June through the end of December is rates will be sub 6 by the end of December.
I talked to him about developing what's called a buy box, where you're very laser focused on a certain type of property in a certain market, even if you're in a high cost of living area. How do you find deals in those high cost areas that still make sense as an investor?
Then I go 3 or 4 bedroom, 2 bath, 1 story, 2 car garage between 1,250 and 1,750 square feet. That was my buy box that I looked at for 3.5 years. In the span of about 6 months, I knew that buy box better than anybody in the entire county of Fresno, California, because it's all I looked at for 3.5 years.
And then I also asked Michael about his schedule as a real estate investor. How much time does he actually spend managing his properties?
So we've set up a communication process. We have a weekly meeting. We now know the reports that we want to look at. It's the same cadence every time. You could get a lot done with texting these days, which wasn't what I had 22 years ago. We're probably spending 4 to 6 hours a month on our portfolio. So what's that, 90 minutes a week? Now, it's different when you're adding and growing because you're going through remodels and all of that. So, if we were in growth stage, there would be more. But if you're in maintenance stage, especially if I'm paying somebody to be that gatekeeper, right? So managing the manager is 6 hours a month for us with our portfolio.
So all of that and more is what we talk about in this interview with Michael Zuber. I think you're going to love it. Let's go to the interview right now. Michael, welcome back to the podcast. Great to have you here.
Thanks, Chad. This is a lot of fun. Thank you for the opportunity.
Yes, absolutely. So in the first episode we did, I looked back, it was about a little bit over a year ago, and I'm going to link to that in the show notes just because it was a really good episode where we talked about your background, your history as a real estate investor, how you got started, and you sort of encapsulated that in your book, which is really good as well, called One Rental at a Time. So I'll put a link to that for everybody to check that out. But I would love to kind of jump off from that first interview and explore a little bit. It seems like we have a lot of crossover, your book, One Rental at a Time, and a book I'm writing called The Small and Mighty Investor, which is coming out not too long from now. And one of the topics, which I'd love just to get your feedback on, is this idea of deliberately buying just one property at a time, staying small, maybe even going a little slower at first, ironically can also achieve big things. You can have big wealth with that, big results. I just want to get your take on why that approach. It's almost like the tortoise versus the hare in that old fable. Like, what's up with that one rental at a time approach? Why is it working?
I think it's working for a couple of reasons. one of the things that I believe is I think getting wealthy is actually a pretty easy 3-step process. But the third step is important and where a lot of people wash out, especially in real estate investing, and that is time. Right? You need under the real estate lens, you need to be able to own the asset. It needs the cash flow. You can't lose it. And if you take the hair approach, to use the turtle and hair analogy, I've seen it. You go out, you squeeze out every piece of equity you have, you slap on seconds, you're doing equity lines on your primary, you're just going debt, growth at all costs. And that might work, but you also might run into a buzzsaw of a flat market, a slight down market, a market where lending is changing. You might run into a market where interest rates go up 500% and you have variable rate bridge debt that's on 2-year terms and you get washed out, right? You may own a great asset, but if the debt structure is wrong and your cap rate explodes or whatever changes on you, you could lose it. You could build a huge Airbnb portfolio based on occupancy in 2020 and 2021, not realizing those were aberrations. And suddenly you come into 2023 and 2024, occupancy down, rates are down, and now you can't carry them. And now you're like robbing Paul to pay Peter and all of that. And so again, I do believe the turtle approach is the right for most people. I frankly believe if you get to 4 and only 4, your life fundamentally changes forever. 1 a year, 1 every 2 years, 4 single family homes paid off by the time you retire. Your financial future is light years away from anyone else. So I tell people to get to 4 and we can talk after that. So totally agree.
I borrowed that topic from you, by the way. I hope you don't mind. And giving you all the credit, I think it's such a wonderful first goal. When you're first starting, it's overwhelming to have all the information, the goals, the big picture. When am I going to accomplish all my goals? But just 4. Just focus on 4 properties.
Just 4. And you could be done. I get it. You don't want to be a landlord. You don't want to do this. But do you want a better future or not? 1 every other year for 8 years, and then don't do anything else. Yeah. You're okay. I mean, that's just a great approach, I think.
Yeah, well, I love the message. I resonate with it. Definitely encourage my own audience the same way. And it's the tortoise versus the hare, turtle versus the hare, whatever you want to call that. It's one of the problems I found when I'm teaching this to people, sharing with it, is just the patience and almost the boredom that people get sometimes and saying, oh, wait a minute, but it's so exciting to see the person on the podcast who went big and they 10X this year and they're 25 years old and they bought 100 properties. And I don't know, there's this allure of the go big mentality, which I get, we have big goals, we have big aspirations, but it's difficult just on a tactical level to have the discipline to do your thing, to ignore the noise, to focus on your next step. Have you found any tricks there? Is any approach there that helps people get the discipline to stick with it?
Yeah, I think there's a couple things. One, we just need to acknowledge that bigger isn't always better. I know there's a very popular content creator that says bigger is better and you're a loser if you don't do 50 units or more and all of that. That's just not true. I believe real estate investing is all about the numbers, and I can show with clear evidence that bigger isn't always better. It's more units, but that doesn't mean anything. It means you could still lose money. It can mean it's a less return. You should be buying whatever the best yield is, cash on cash, return on capital, whatever that is for you. And that said, the other thing you need to realize is what hassle factor do you want to sign up for? If your life is already busy, you have a travel job, you're a growing family, you have 20 minutes a day, and that's all you have to devote to this, you don't want to own apartments. You want to own single family homes. They stay longer. My average 10 years over 8 years. My apartment's just under 2 years. It's just this. And then let's just be honest about the math. There are people out there quoting gargantuan unit counts, and they own 1%. Yep. Also, let's be honest. There are syndications, which, oh, by the way, are blowing up now. But the better the name, the lower the return. There's just real estate investing goes through these themes where people think it is easy. I talked about Airbnb arbitrage, syndications. Real estate investing is never easy. It takes work. You have to hold for 10 years to get wealthy. You can't bust out in 4 years. So for most people, That's just a boring single family home. By the way, in a market that is changing and evolving, what is always the easiest thing to sell if you need to? A single family home. You want to talk about hard things to sell today? A 20-unit building with variable rate debt, with cap rates exploding, occupancy going the wrong direction, taxes up, insurance up. You're going to lose. You can lose a lot of money by thinking bigger is better.
Yeah, I heard a metaphor when I first started that real estate's a lot like playing chess. I don't know if people don't know about chess or don't play chess, they might not get this metaphor, but having chess pieces that you can move on the chessboard is always very helpful. And in fact, the pieces that can move the most directions and the most times are the most valuable pieces. And so single family houses, that simple, dead simple single family house, I would add, the little duplex in a residential neighborhood. Those things are financeable. They're easy to sell. Yeah. They're easy, and you don't have all your equity in one big basket. If that's like a big boat that you're trying to move. It's a huge, gigantic thing. Whereas a little house, flexible, move, sell it, buy this one, sell this one. And so I love your point there that when times change, which they always do, economies always change, the more flexible you are to move your chess pieces on the chessboard, the more likely you are to do it, to adapt to the next thing, whatever that is, and take advantage of the next thing.
Yeah, and again, people don't realize you can lose a lot of money in real estate investing, and it's happening in commercial right now. I mean, there's a great example, 350 California Street in San Francisco. I don't remember the exact numbers, but I'll be close. It last traded at 150 million. It just traded again at 30 million. That's an 80% discount, right? You're not seeing that in single family. You don't see 80% discounts in single family because you have investors, you have owner occupants, and especially if you focus below the median where they're not building those homes, the first-time homebuyer homes, remarkable security. Not also to mention 30-year fixed rate debt. You know why the United States is so lucky as investors and homeowners? 30-year fixed rate debt. You want to know why Canada, the UK, New Zealand are suffering in housing right now? It's because they have debt 5-year ARMs, and they've gone from sub 1% to over 4%. That is a huge change in mortgage payment. So we are so lucky, so fortunate to have 30-year fixed rate debt on residential properties. It's an amazing thing that most people, and you can get a fourplex on 30-year fixed rate debt. It's game changing, life changing.
Yeah, such a good point. Like a lot of the residential markets, I'm here in Spain as well, but you look at UK and New Zealand, their residential markets are experiencing some of the pain that the commercial market is in the U.S. because of adjustable rate resets. They're going up.
It's always the debt. I wish more people got that. Real estate it's not the real estate, at least in most cases, barring some kind of toxic spill or something. It's the debt that blows people up. That's why I talk about getting wealthy as 3 steps, and the third step is you got to hold it for 10 years.
Yep. Yeah. Let's talk about debt. Let's double click on that. I want to go into it a little bit. This is one of those trendy topics as well. And I'll just briefly tell my story of debt and real estate investing because everybody's got a little different approach. When I first started, I just graduated from college. I didn't have the W-2 income. So I know you coach a lot of people. Hey, go out and get the conventional loan. I do too. Like that. If you can get a 30-year fixed conventional loan, that's the best thing going. I had to do a lot of creative financing. I used seller financing. I used lease options. I used a lot of partners and private money. But what I want to kind of zoom in on a lot is if you had to choose, I think you've already alluded to it a little bit, let's give a hierarchy here of what type of financing people should be focusing on the first 4 deals, the first 5 deals, 6 deals. Like what is the best financing and why? Like even getting a little more granular, even the 30-year fixed, we talked about that, but what should people be looking at out there?
Yeah, I think if you're looking out over the next 30 years, I'll go back to it because I just think you want to control as much. Sam Zell, who rest in peace, just passed away recently, had a saying that basically said why real estate investing is the way to go is because you have fixed rate debt in an inflationary environment. What that really means is your debt payment stays the same other than taxes and insurance while rents go up, while your mortgage pay down happens. It's an easy way to get rich. So you don't have to outthink, the great Sam Zell of, if you don't know who he is, do yourself a favor and look him up. He's the original grave dancer from the SNL crisis in the 80s. But back to what I would look for, if I only could look for one thing, it would be seller financing, right? I've done millions of dollars in seller financing. If I could only do one thing, that's what I would do. I would ask for 30 years. I will admit that generally you can't get 30 years because usually I'm buying from older operators. They want some balloon payment or some end date. I would go for at least 10 years, right? You want length. I would never do a 1 year. I would try to avoid a 5 year. But if I can only do one thing, it would be seller financing. And then if you're coming next, I do think we're going into the next 5 years will be the time for creative financing. We're talking sub-2, novations, things of that nature, things I have never done. I am looking to add to my tool belt because even after 22 years, I have things to learn and grow. That would be the next thing, right? Who wouldn't want to take over a 2.5% 30-year mortgage on a house if you can, right? Via an assumption or novation or thing of that nature. So that's kind of how I break it down. Ultimately, you want the longest term and the lowest fixed rate payment.
Yeah, I feel the same way. Seller financing, the best I've been able to receive was 25 years. And I've also been able to get really low interest rates though. That's what's really interesting.
Sure.
I can get a 20-year, 25-year. I could get 3%. I've gotten 2%. I've even had some 0% notes where they had to pay the IRS, like a imputed interest rate. But there's so many creative things you can do. Particularly, I agree with you right now in 2023, is that if it's more difficult to cash flow with retail loans, you got to figure out a way to get creative. And so seller financing has always been, it's not the easiest one to get. That's the warnings for everybody that it's just to go in and make a low offer with them not knowing you is how you can get buy a property typically. But with seller financing, almost every single time I had to have a relationship with the seller, even though I got one deal through a realtor where they seller financed it to me. But even then, my realtor had to really go to bat and talk to the seller and get them to let them know me. So it's almost like you're building a private lending relationship with the seller. And you've done this as well. But just for people who are interested in that, it's a fun negotiation. It's one of the most rewarding negotiations. But you have to really get your head around it. You got to think about the negotiation a little bit different. I'm not sure, has that been a similar experience with you?
Without question. Yeah, without question. You're essentially going to someone and borrowing hundreds of thousands of dollars. It is secured, so it's an asset. But yeah, they're going to want to make sure they get it back. They're going to be betting on you. The last thing they want to do is foreclose because that's a legal process because, again, they're acting as the financial institution here. So yeah, it has to be a relationship. Every financial deal I've done, we've had to grow a relationship. We've broken bread. As you do more of these, sometimes they want to talk to each other and get references. The last thing I'll say about seller financing that I think sometimes even you and I may do this inadvertently because we've done it and had so much success. We make it sound like every property is available for seller financing, which is absolutely not true. One of the things you must do is you must figure out if that seller can even say yes, right? If they have, a 98% loan on the property, seller financing isn't going to play. Yep. They have to have some equity skin in the game. It doesn't have to be free and clear, but there's got to be, you've got to be some room for them to even say yes.
Absolutely. Yeah, I'm glad one of the main filters I had when I'm out looking at properties, I look at three things. Look at location, number one, which I want to talk to you a little bit more about your ideal locations. I look at motivation. They're just trying to get top dollar and waiting all day. It's not going to be the ideal property for me or the situation. But the third one is the amount of equity. Sometimes you have to guess at that by, how long have they had the mortgage. Sometimes you can ask them outright, like, hey, are you paying a mortgage off when you sell this property? And sometimes they'll just tell you. But if they don't have any equity, which is one of the problems I have with the subject to kind of resurgence, is that there's this idea that it's like a magic technique that you can buy a property, get a deed to it, take over the payments on somebody's existing mortgage, even if it's 2.5%, 3%, that's great. But there's almost this strategy that like you should change your approach to analysis. Like, oh, well, just because you're buying a subject to, you can buy a property that doesn't have much equity or that, just because it's not your loan. But the way I look at it, I haven't done a ton of subject to recently. I did more early on in my career. I had an obligation to that seller, even if it wasn't contractual. And if that property was called due, the due on sale clause was called due, which is the big risk of due on sale. That could happen, right? If the interest rates keep going up, there's gonna be a lot of banks calling those loans due. You've got to be ready to pay that off. And so I'm a little squeamish about I like the strategy. I like it when it's done well, but I think it's a little oversold and a little, especially to new investors.
Yeah, I think, I think we've talked about this, right? I get really nervous when the herd goes one direction. I just said earlier that I think subject to is going to have a renaissance the next 5 years. I just said I'm going to invest in myself learning it. But just because you can doesn't mean you should, right? One of the rules for one rental at a time is we don't do alligators. What is an alligator property under subject to? Let's just say the mortgage payment on a house, PITI, is $2,000, but you can only rent it for $1,500. Well, one rental at a time says don't do that deal. I'm afraid that the fervor and the energy behind all this says you do that deal because you got it for nothing and you got a 2.5%. Who cares if it's 2.5 mortgage? It's negative $500 a month before repairs, before expenses, before. Are you kidding me? Just because you can doesn't mean you should.
Fundamentals. And so we've dug into some financing. It's part financing, it's part real estate. Those are the two like major pieces of the puzzle. You got to figure out the financing. I want to go back to the real estate because I love your approach of zoning in on a buy box. I do this as well, of just making sure people understand and get super clear on what kind of property, what kind of location they should be investing in. And I'm just curious for you and maybe some students, people you're working with in 2023, what are some ideal buy boxes for you when you're looking at a property?
Yeah, so I still think my first buy box is a great example, right? So I started this journey with a buy box 22 years ago, and let's just kind of level set. So I was investing in a market, Fresno, California. I never lived in. I knew no one. I had driven through one time when I was 13 going to Yosemite National Park. So I knew nothing. It's 1 million people roughly. There's no chance in heck. And oh, by the way, it's 3 hours away. It's not next door. So what do? Is I talk to a bunch of people in my network that I start to build, and I find a zip code, 93703. It was called the Mayfair District. Okay, now we're talking, I don't know, 200,000 or 150,000 people. Still too big. I then go single family homes. So I ignore duplexes and everything. And then I go still too big. Then I go 3 or 4 bedroom, 2 bath, 1 story, 2-car garage, between 1,250 and 1,750 square feet. That was my buy box that I looked at for 3.5 years. In the span of about 6 months, I knew that buy box better than anybody in the entire county of Fresno, California, because it's all I looked at for 3.5 years. I could find the value. I knew it quickly. I could scan the available inventory in less than 5 minutes. I would write the great offers. I would follow up. I would write offers, be the second highest, and I would follow up once a week. Is it still going? Is it still going? I would get deals that fell out at my price that never went back on the MLS. That is all I looked at. That's the buy box is powerful, not because of what you look at, but because of what you ignore, right? If I take that criteria, 3 and 4 bedrooms, blah, 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 just to another zip code, it's entirely different. Rents are different. Price points are different. You have to be consistent and focused. Most people get it wrong in real estate by looking at too much. Just the way it is.
Agree, 100%. There's a sort of compounding that goes on, not only with your properties, but with your knowledge when you're laser beam focused.
Exactly.
Yeah, I was the same way. I used to tell people when I look at my zip codes are a little smaller population wise, but 29630, 29631 were my 2 core zip codes. And there's 15,000 people in one and maybe 20,000 in the other. So I have a market of 35,000 just with everybody. And then you narrow that down to single. I had to be a little bit more of a big fish in a small pond. So single family, small multifamily, just to get some deal flow.
But you had to have the inventory, right? You can't look at 3. So I tell people, create a buy box that gets somewhere between 20 and 40 active listings.
Yep.
There you go. Go for it.
Yeah.
If it takes 2 zip codes, so be it.
100%. Yeah. One of the most important lessons. Love it. Buy box. Has that evolved any? So 2023, is it pretty similar? When somebody brought you a deal in the same zip code, is it that type of property?
Yeah, I would certainly do those deals. I am lucky enough to be at the end of my cycle, right? 22 years in, already financially free for 5+ years. So I can be very selective. Right now, what I'm looking at doing is probably repeating what I did in 2006. So right now I'm investigating in small multis, so 5 to 40. I believe there's a lot of pain coming. So I likely will be 1031ing out of houses into small multis. So my area right now, I know there's pain coming. It's out there a ways, but that's probably where I'll be spending a lot of my time is again, trading out of fully valued single family into underappreciated, medium size or small multis.
Yep. Well, let's go to this idea of transitioning, since I think that's a good jumping off point. One of the things I wrote about in my book was just that every question you ask, whether you're talking about acquisitions, financing, property management, building a team, somebody asked me a question. My question back to them always is like, all right, well, what stage of your investing are you at? Are you a starter, or are you just buying those first four houses? Are you kind of a builder where you're just in the crux of it, you're in the details of building wealth, or are you at the third stage where you're more like an ender or a harvester and you're trying to actually just live off your income? And so I want to, we spend a lot of time on the starters, at least I do. And I think there's a lot of people there, it's important, but I want to speak to the kind of that second phase going into the third phase, because you and I have both been through that. And I think it's a really interesting transition. And one of the things that I tried to write a lot about was that it's like you're playing a game where there's certain rules that work when you're playing football and you're trying to throw the pass this way or do this certain scheme this way. But as soon as you switch to a different game, now you're playing baseball, you got to change your rules. And It kind of seems that way to me about going from wealth building, leverage, growth. And then when you get in this last phase where it's about, as you mentioned, transitioning, moving your equity, it's more about paying the debt off. I just want to see your initial thoughts on how you've changed your gameplay as a wealth builder and then in that third stage from where you did earlier.
Yeah, I think there's a couple of things as you enter the third stage. I think you never, at least I don't see myself shutting it off, right? I've been looking at my market every day for 22 years, and I likely will look at it every day for the next 22 years. I'm not adding markets, right? Some people, they get to this point where they have freedom. They just want to get bigger. Just to get bigger for bigger's sake, that's not me. Right. So I won't be changing markets. That's one thing that I think is fairly certain. Could I? Absolutely. Will I? Probably not. But the first thing we did once we acknowledged that is we looked at our portfolio and we said, we looked for the outlier. And I remember there was a property on Glen. It was a triplex, a house in the front, a duplex in the back. For whatever reason, that property, we were just snake bitten. It was a great property. It was a good property in an okay area, but it just didn't work for us. So one of the things we did is we sold it, right? We took the one property that caused more than 50% of our headaches and got rid of it, right? We did that. And then we took that payment, we paid off some debt. So our cash flow stayed even, but our headaches went down. Another thing that we're actively looking at right now is we obviously have enough, but we also want to give some to our daughter. So one of the things that we will likely be doing over the next 10 years is we will be taking some of our older single family homes, 1031ing those into brand new construction. That will produce a lower yield, but the headache factor will come way down because we know that someday we will die and we want to give our daughter newer stuff, right? So we're about reducing headaches. So those are some of the things that we're doing. And again, we'll never stop growing. It's a game, right? This is not football where you kind of age out. I still look every day. I talk real estate almost every day. It's fun, but we are definitely not these people that say, hey, we want to be billionaires. We've thought about it. We've talked about it, even 100 million. That's just not us. We've gotten to a point on the cliff that we're comfortable. We've chosen to sit down. Could someday we stand up and go, we're going to go up again? We've recharged, we reinvigorate, maybe, but not today. I think everybody has to make that choice. We have a remarkably good life. We just spent a month in Southeast Asia. We just did the penthouse at the Venetian. We do kinds of crazy things, but we don't need the private jet and the whatever. So that's just where we are.
Yeah, I love it. Yeah, I love the legacy piece and the kind of thinking about the next step with your properties and with who's going to inherit those properties. Also, I want to kind of zoom in a little bit on the debt structure. One of the things I've gotten into internet debates on people with is actually that you should be paying off debt eventually. Like I've been doing that myself. We're not 100% paid off, and I don't think I'm convinced that I need to pay off 100% of the debt on my portfolio. But definitely one of the transitions for me was, okay, we have this capital, we have this income coming in, we have some excess cash flow. Where do we buy more properties with it, or do we start paying debt off on the existing portfolio? And I'd love to get your take on that. I'm happy to give some of my opinions on it, but I want to see what your thoughts are on actually eventually paying off some debt on your portfolio.
So one of the things that we did kind of the year after I retired, which is now 5 years ago, is we looked at our portfolio and we took, I don't know, maybe 5 to 8% of it. I don't know the unit count, but we took a portion and we paid it off. We affectionately called that our blank pile, right? We'd been through the Great Recession. We saw crazy things happen. So we paid off a chunk that we felt we could live on if all hell broke loose, right? So we have that insurance policy. The other thing we did over the last year, people are on my channel, is we refied almost everything to sub 4%. We have apartment buildings sub 4%. We have office below 4%. I will not pay off debt that has a 3 on it. It's not happening. Not happening. But if it had a 6 or higher, yeah, I could see paying that off. But I have most of my portfolio free and clear or sub 4%. I am not in a hurry to pay off sub 4% debt in a world where inflation will likely be 3% for most of the rest of my life. So that's kind of my feeling about some of that. So we took action, right? Again, apartments, generally speaking, have variable rate debt. I found a non-QM lender that would do 30-year money on apartments at 3.99. I did all those I could. So again, I won't be paying off that debt anytime soon, I don't think.
Yeah, so whether it's free and clear debt, whether it's securing long-term fixed debt, which gives you a lot of runway and a lot of leeway through a lot of storms, or piling up cash, I assume, as well, is something we've done a lot of. Just having a big warehouse if you need it, or however much cash you have just in case is a nice thing to have.
No, yeah, stacking paper. Again, real estate runs in cycles. People always feel like it's, this time is different. It's not. It just moves around. We have more dry powder today than we've ever had by orders of magnitude. Because again, one of the things when you're in your build phase, right? We talk this as phases. I was cash poor other than an emergency account that we never touched unless it was an emergency. I was cash broke all the time, right? We would stack, buy, stack, buy. Now, we stack. Oh, we'll buy that one. We'll stack. We'll buy that one. So very different.
Same here. And so another way, even if we do keep debt on some of our properties, some ways we advance more conservatively is maybe pay cash for the next property. Sometimes we'll do that. Then we can always refinance the next one. But it's just, I guess, the sentiment I'm trying to get, and I'm kind of getting that from you as well, is that there's sort of a change in approach. That different game you're playing is like, all right, look, I've got this wealth I've built. Yes, I'm not hanging the cleats up. I'm going to keep playing the game to the day I die. That's fun. I love doing it. I've got money I can give away. Like, I like playing the capitalist game. At the same time, going back down the mountain where we came from is a non-starter, and there's a lot of people who try to shoot for the moon and keep going and keep moving the goalposts without ever taking some chips off the table, so to speak.
You're absolutely right. I mean, like your goal is to get to 4, maybe you take it to 10, and then you just keep getting bigger to get bigger, and you just keep. It's like staying at the craps table or the blackjack table or whatever the gambling you want to do. Eventually, you stay too long, your hot streak ends. And if you are max leveraged, the market will smack you, right? I knew a guy that the 06 crisis, he was legitimately worth $10 million. He happened to be flipping $1 million homes in the Bay Area. And I remember the day he didn't take a $50K loss. That $50K loss would have meant he built his war chest back up because he would have replenished and being able to survive. Because he didn't take that loss, he stayed max leveraged, and then this, and then that, and then this, and then he was bankrupt like 9 months later. It's a huge mistake. You got to have the wherewithal to keep going. Stack cash is good.
Yep, for sure. Well, let's transition back to the current times, because I love your daily YouTube channel, which people need to check out if they haven't seen it, and your podcast. You get into a lot of different current topics and trends. Some of them real estate related, some of them just the economy. So because you have a good pulse on it, I want to get your opinion on where we are right now. Like, maybe we could just give if you're the doctor looking at giving the pulse of the real estate investor economy here, like what's going on right now? Like, we've had higher interest rates. I know that the inventory seems to be, in a similar spot. Like, what's your assessment of where we are at this point in 2023?
Yeah. So we're recording this kind of the middle to the end of May. For clarity when people watch this. I think there's a couple of things going on. One is, I think bonds and mortgage rates, because of the debt ceiling, is yet to be resolved. I think we're in a period of the next 2 weeks where rates will go higher. I actually believe that mortgage rates will touch 7% again. And then what we will see kind of middle of June through the end of December is rates will be sub 6 by the end of December. Why can I say that? Well, because I believe inflation will be rolling over. There's these things called base effect. There's these things called lead lag with housing costs. All of these things we can get into if you want to. But basically, I think inflation will be coming down. once we resolve the debt ceiling. The Fed's on pause for the rest of the year. I don't see rate cuts. I don't see any more rate increases. They will talk tough, but nothing else is coming. I think inventory will stay down not only the rest of this year, but next year as well. I was featured in a Fortune article probably 2 months ago where I basically said the Fed broke housing. Lots of people bought, but also more people refied to sub 3, sub 4% debt, like I talked about earlier. They're not in a rush to sell. So inventory listings are down 22 to 40% in San Diego, for example. That's not coming back anytime soon. I do think we have an economic recession, but it's not a nasty one. It's kind of a shallow recession, kind of talking negative 1% maybe over the course of the next 12 to 15, 18 months. I do think unemployment hit a cycle low at 3.4. I think it goes up from here to maybe 4.5, 4.8, maybe 5%. Nothing crazy, right? When I was getting my econ degree, 6% was considered full employment. So I'm talking about going from 3.4 to 5. That's about 1.5 million, 1.8 million more people unemployed. But yeah, that's kind of where we are. We've got a recession. Either it has started or in the near future, but not a great recession, not a depression. At least that's currently how I see it.
So I'm thinking about a lot of our listeners, our small and mighty investors, our one rental at a time investors, and how this, however this plays out, the types of things they should be thinking about, because it's hard to predict exactly what's going to happen. But one thing we've talked about is adjustable rates. If you have the risk, of having adjustable rates, that locking in a rate, even at a higher rate for now is one thing to think about. But what other moves do you think are sensible given where we are, given what the next steps could be?
Now, I would tell every investor, one rental at a time, the mighty investors, to always price out their deals with 30-year fixed rate debt. That way you've protected the downside, meaning rates going higher, but you can always refi later if rates go down. So you have the good without the bad. At least price them out that way. I do think there are ways, at least this is something about California. I know Washington has done this. This may occur in other states, but there's such a dearth of rental units or housing stock. One of the things in California that I'm hearing more and more good news about is ADUs, accessory dwelling units, taking a single family and creating a duplex. Right now, I'm looking at that because I do believe the spread, the value of the cost of building a 750 to 1,250 square foot is less than I could buy it for. So that adds margin. So what that might mean for someone looking at their first house is go look at and understand, what does a small 2-bedroom, 1-bath or 3-bedroom, 1-bath house cost on a big city lot? And can I add a unit? Because maybe there are ways to arbitrage and create value by buying one and then building one. I do think there's value in small multifamilies. I think house hacking, oh my gosh, the one financial regret I have is not house hacking a fourplex in 1992 in the Bay Area. My life would have been fundamentally different a decade later. I didn't even start my journey until I was 30. If I could have house hacked at 20, oh my goodness, it would have been different. So if I was young and starting over, you better believe I would be house hacking. 3.5% down fourplex all day long. Those are things you need to look at. But in the end, one rental at a time, the mighty investor, 30-year fixed rate debt, do good or great deals, must cash flow day one. They're out there, they're hard, but it is absolutely possible in any market.
So a question I get a lot, and I know this is a good perspective for you because you invest in California, is the folks in California, Washington State, Washington, D.C., the Northeast. Yeah, I hear you, Michael. I hear you. I should have a positive cash flow. I should at least price it with 30-year debt. But I'm looking at these $800,000 single-family houses that have a $2,500, $3,000 rent. Michael, Chad, how can this? This is not, the physics aren't possible, Michael. Like, how am I supposed to do this? So,
well, I don't know. You could probably repeat what I did. So again, if you go back and read my book, One Rental at a Time, I wasted a year. I should say I wasted 6 months and I invested 6 months. So I live in the Bay Area, also called the Silicon Valley. It has never made sense to cash flow here. But I didn't know that because all the books I read said, invest in your backyard. So I tried. So for the first 6 months, I call that investing. The next 6 months, I call it wasting because I was too stubborn. So what I did, and I believe most people can do this, is pull out a map of your state or your area and just draw circles. I had to go out 2.5 hours by car to find a market that did cash flow. My first house I bought was 107. It rented for 1,100. The 1% rule. I don't believe in it, but that's simple math. You can do that. Most people within a 2.5 hour drive can find a market that does work. If you are in Silicon Valley, Palo Alto, Cupertino, doesn't work. But LA, you ever hear of the Inland Empire? Right? There is a market that makes sense. I just think most people don't look out far enough.
And that basic relationship between rent and price is one that's a little easier to get our heads around. Even the 1% rule, you don't want to apply that across the board, but buying a property that costs $1 million and it rents for $2,000, not going to work. Like all day long, you'd have to pay 100% cash, and even then, it's going to be tough to make cash flow. Have you seen any rough relationships in California in particular? If you buy a $400,000 house that rents for $2,000 a month, or is it? I mean, is there kind of a rough?
It's all about. The debt structure sure has changed. What worked a year ago is not working today. Obviously, 3 versus 6%. No, I mean, you just got to do the work. You got to figure the down. You're probably going to have to put 30% down versus 20% you may put elsewhere. But it is absolutely possible. Something around 0.75, 0.8 to kind of use that is possible. It may not be the greatest thing, but usually it comes down to adding value. For example, one of the things I did the last time this crazy cycle happened is I looked for 2-bedroom, 1-bath homes that had 1,000 square feet. Now, this didn't always work, but when it did work, it was amazing. So if you don't know, 2-bedroom, 1-bath homes cost less than 3 bedrooms because they're not looked at as often. But if you're a landlord and you find a house with the right footprint, you can go add a wall, a door, and a closet, and suddenly you have bought a 2 and rented a 3. Right? You have to find the ways to create value. Again, I talked about ADUs in California. Maybe the answer is I got to pull a full boat for a 2-bedroom, 1-bath house, but I can build a 2-bedroom, 1-bath house in the back with alley access for less than the cost. So now I have a duplex. So it's never easy, but it is possible.
Yeah, if you just look at a listing and say it is what it is, and you don't use any creativity or any thinking outside the box, you're even in my markets, South Carolina, Georgia, when I first started investing, I mean, every market, you've got to think outside the box. It was sort of an anomaly for the last 5 years where you had these really low interest rates. We could go buy an MLS. I mean, it just wasn't a typical thing. But, I've had students in California. I've had a mentor of mine, John Schaub, has always said, even 30, 40 years ago when he first started teaching, his wealthiest students were the ones who bought in California and just figured out a way to hold on, and they held on. They're the wealthiest. They're by 3 or 4 factors. They're the wealthiest because they figured it out. It wasn't easy. It was much harder than other places, but if you look at the fundamentals of whatever market you're in, if there's a tailwind behind you, if there's a limited supply, which California always has because for lots of reasons, and then you have a demand, which there's still demand, that's going to be a good long-term formula. So seller financing, we mentioned, creative financing, those are 2 good tools. Looking for ways to add value to 1,000 square foot 2-bedroom house and add a 3rd bedroom, looking for ways to add an ADU, all of go out and look for these ways, listen to people like Michael and find ways. There's ways to add income to a deal, to add value, but you have to think outside the box. You can't just,
you got to skill up. I mean, it just doesn't fall in your lap. If you look at the MLS and, hey, Michael, I have my buy box. I looked every day. But in 90 days, you're not seeing around corners and seeing opportunities. You're not really looking. You have to when you do this and it becomes part of you, you create value with your knowledge. That's the power in this.
100%. All right, I want to transition as we kind of reach the end here to, you've bought this property, you're one rental at a time. To hold it 10 years and to make the money, you've got to be a buy and hold investor who manages this property or manages the manager, one of the two. And another one that I've gotten pushed back on a lot from, in addition to paying off debt, was this whole idea that it's possible to only work a couple hours per week on your rental properties eventually, that you can get it pretty passive, you can get systems built. It doesn't start that way, but you can get it that way. So I want to get just some high level feedback from you for people on property management, managing the manager. How do you eventually get this to where, hey, I don't want to spend all my time managing these properties? What are some of the key things that you've had to do with your own rentals?
Yeah, you've got to just, again, I've used a property manager since day one, given how far away they were and I traveled for my job. So self-management wasn't an option. But basically, it is just processes and procedures. So we've set up a communication process. We have a weekly meeting. We now know the reports that we want to look at. It's the same cadence every time. You could get a lot done with texting these days, which wasn't what I had 22 years ago. But yeah, even with our portfolio, I asked Olivia the other day for another conversation. We're probably spending 4 to 6 hours a month on our portfolio. So what's that, 90 minutes a week?
Yep.
Now, it's different when you're adding and growing because you're going through remodels and all of that. So, if we were in growth stage, there would be more. But if you're in maintenance stage, you should hope that it's not, especially if I'm paying somebody to be that gatekeeper, right? So, yeah, managing the manager is 6 hours a month for us with our portfolio.
Well, I'm curious about your weekly meetings. What kind of stuff goes on there? Do you have, is it a 15-minute meeting? Is it longer?
It's typically, so we schedule a half hour. I don't remember the last time we used all half hour. It starts with rent collection, and we do this every Friday, 10 a.m. Rent collections, late pays, repairs, upcoming vacancies, right? Anybody give notice, things of that nature. Those are the things that we go through in that order. And we have the reports. We do it on a Zoom call now. If the Friday's a 4th, it's kind of, we don't really talk about rents because it's not even late to the 5th. That's just, it's the same call every time. And then again, we have a threshold of $500. We must get multiple bids on anything over 500. It used to be 250, but now we've had the same team for so long. We trust them a little more. Are we being ripped off? Maybe. Do we care? Not enough to lower the limit, right? So that's how we kind of treat our business.
Yeah, I love the meeting idea. It's not something I do, but I'm taking notes on that as well. I like that. I do it more of a quarterly meeting, but I think I can move that up a little bit. I also have a $500 per event rule, and I compare. I can tell a lot of people, like, a lot of how I look at my rental properties is through reports and numbers. And it's kind of like the Matrix, Neo in the Matrix is always, he looks at everything with zeros and ones. And like my rental business is reports. Here's how much rent I think I should get this month, or I know I should get. Is $3,000 less than what I should get? Like, what's going on here? Call the property manager. How's it? What's going on? What happened with that? But I like the getting proactive and asking about the repairs when they're fresh like that. I think it's a little more helpful.
And we look at it every week. It's no surprise. One of the reports that we looked at during the pandemic, which was, we didn't always look at, but we actually had created, and we still get it. We don't look at it as much, but we looked at it every day for a while, was this month's rent collection compared to last month. Mm-hmm. So the 4th to the 4th, the 5th to the 5th. That way we could see any gaps, like, oh my God, we were just down $5,000. What happened? Yep. So that was a very valuable report that we didn't always look at, but we started looking at the last couple of years.
Yeah, I like doing the same thing year by year as well, just to say, all right, cool, we've got this much rent growth, or we've sold a few properties now or less, and the same with wealth, your equity, like, all right, year by year. It's just when you do that year by year comparison or the month by month comparison, that's such a helpful perspective, because you can see your growth in real time, or
you can see it's really working. It's working, for goodness sakes.
Yeah, exactly. All right, well, awesome. I love that. So I'm confirming, and people can quote that Michael Zuber also has a 4 to 6 hour month, or less than a 2 hour week. So we're on the same page there. Very good. All right, so I want to transition to a couple of other just last minute topics. Are just curious for me that I know you have more experience than I do, but people ask me a lot about. And one of those is using turnkey rental companies as a source of lead flow for buying your properties. I've had one recent question that somebody asked me where they had some red flags come up, and I was a little, just cautioned him a little bit, because there was just some there's a little bit of a conflict of interest, and there was this person who was trying to sell him a property, and he didn't want him to get his own inspector, and I was like, no, you always get your own realtor inspector. So I guess stepping back from that specific situation, just what are your thoughts on that process in general? Somebody who's a long distance investor using a turnkey company to buy, and then what are some best practices maybe that they can take from you who've done that before?
Yeah, so this is really key where you are in the market, right? So turnkey providers provided margin of safety or instant equity 2 or 3 years ago. That's just where we were in the cycle. Today, they're getting full boat and full boat plus because there's just not a lot there. I think most people, unless you're somebody who has absolutely no time, which I think everybody can find 20 minutes a day. If you absolutely have no time, maybe it's not what I would think would be a good option today. Maybe 3 years ago, it was a decent option. But today, I think you could do better on your own, in my honest opinion. Always get inspections. They obviously have self-interest in mind. They want to reduce the risk of credits and all of that. You have to get your inspections. Never, if anybody says don't do it or here's a report, no chance.
Got it. Good.
But I'm not a big fan today, honestly.
Okay. Well, let's go to a cousin of that. All of these are for the people who usually have very little time, as you mentioned. And they're like, I want to get into real estate, but I don't have the time to do the work, which is kind of, there's some trouble. It's also looking at syndications. I've heard a little bit of your opinion on that. What's your thought on why are we buying? Like, I'm a direct investor fan. I like owning the property. I feel like there's some safety there. I feel like I trust my property manager and my tenant more than having to figure out this operator I'm investing with. And I just don't like having 150 partners. That's just not my deal. But I know some people love it, and just want to get your thoughts on it as well.
I am not a fan of syndications. And I was warning people about 18 months ago about the impending disaster that was coming. And I have receipts to prove that I warned these people. I believe real estate investing is hard. I believe real estate investing goes through cycle where sometimes people think there's an easy button. And over the last 18 months to 2 years, people have thought larger and larger multifamily is the easy button. You buy it, you do a value add, you sell it for more. Well, you're getting bridge debt, getting this, getting that. And a lot of these people are going to blow up. I don't know if you've heard about this. There's a 3,200 unit building in Houston, Texas, or a set of 4 buildings in Houston, Texas. 11 months ago, raised $100 million from limited partners. They lost the buildings. $100 million wiped out overnight. And frankly, it was wiped out the day the deal was done. The deal was overpaid by an inexperienced operator who raised $100 million because it was easy. No, thank you. We are in an environment today where people are going to have what I call cash in refis. In order for us, cash in, not cash out, cash in refis. In order for us to keep this building, I have to raise another $10 million from the limited partners. I don't want partners because if 50% say yes and 50% don't, it's just going to be a disaster. Like you, I don't want partners. I don't want one partner, let alone 150 partners. It's just not my thing. I want to live and die by my decisions, not the stupidity of others. And the reason people ran to limited partners is because they got googly eyes over people getting lucky. They bought it a 6 cap. They sold it at 3.5 cap. Why? Because rates went to 0. Rates are now 5 or 6%. Cap rates are exploding higher. Deals are blowing up everywhere. You all are going to lose a lot of money, and I told you this was coming. So, no, limited partners, for that matter, Airbnb. You want to know another thing that sets me off is all these people talking about Airbnb arbitrage being the way to build portfolios with no money down. Dude, you're subleasing properties that are not on the beach. Airbnb short-term rentals are amazing for the right property in the right location. It's 2020 and 2021 are not the years to price Airbnbs because nobody was going to hotels. Guess what? That's changing. Right. So again, lots of dumb money went to Airbnbs because all the gurus said it was easy. A lot of dumb money went to limited partners and these deals that are going to blow up. So I would rather live and die by my decisions than somebody else.
Yep, well said. And with all of that said, even if you are someone who experiments, and I have some Airbnb deals that have gone well, and I've had no people who have gone well, the small and mighty approach, the one deal at a time approach also prevents you from getting in over your head if you do a bad deal. If you do a bad deal and you're like, oh crap, the Airbnb arbitrage did not work that well. This market, the demand changed. I'm upside down a little bit on this property. The good news is you did one property and you didn't do 10 of those. And so going full circle here, all the way back to the first conversation we had, that if none of us are perfect, I've made a ton of stupid mistakes. I've done bad deals, but I think the encouragement that I really love about your approach, Michael, is that you got to learn as you move. You've got to take it deliberately, one deal at a time. Mm-hmm. And if you do that, if you put it together, you're going to learn just one or two little things in your market. In your little buy box, it's going to start working, and you hold on, you buy it in a way that you're a long-term investor. And there's nothing fancy about that, but boy, is it a beautiful thing when it works over the long run. So thank you for the work you're doing and what you're teaching to people. I really, really appreciate it.
Yeah, no problem. I enjoy it. And one thing I'll say about those 4 units, the one thing I would ask each person to try to do is make the second deal better than the first, make the third deal better than the second, and then make the fourth deal your best deal. And you can do that because you're getting experience and you're learning. And if you only ever get to 4, congratulations. I want to shake your hand.
Well said. I love it, Michael. Is there anything you have going on you want to let people know about? Places to connect with you? I'll put all of your links in the show notes in the description if people want to check that out. But want to give you a shot to let people know what's going on with you as well.
No, I guess the one thing to highlight is I do a daily financial news show at 7:30 a.m. On my channel. It is live, not edited. I don't edit any videos. So yeah, come tune in, take a look. We usually get 200 or 300 people live each day, which is a lot of fun to interact with folks. So check it out.
So for someone who edits all my podcasts and edits YouTube videos, the fact that Michael can deliver day after day is from a podcaster standpoint, well done. You're doing good work, Michael. I like it.
I appreciate it. Thank you.
All right. Have a good day. Thanks a lot.
Take care.
Thanks for listening to this episode with Michael Zuber. I hope you enjoyed it. If you like this episode and you're watching on YouTube, I'd really appreciate it if you give me a thumbs up, a like, and leave a comment. It only takes a second, but it's a big help with me to help spread the word with the YouTube algorithm. And if you're listening to this on Apple or Spotify, I'm always appreciative if you leave a review. People read those and it helps me to spread the word with new listeners. And if you have any feedback on this episode or suggestions for other episodes, I'd always love to hear from you. You can send an email to podcast@coachcarson.com. I hope you'll join me next week in the podcast. I've got another fantastic interview that I think you'll love. Thanks again for listening, and I'll see you soon. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I have not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.